Exchange, Chris Kairinos, is here to give us his predictions on what is likely to happen at the OPEC meeting taking place later on today. But before we get into that, Chris, give us some context regarding to how much the oil price has fallen.
All right, well, given what happened in June, we had the rise of ISIS and we had a very tense geopolitical arena in the world, and everyone was worried what's going to happen to oil. Supply disruptions did not really happen, everything was still, it was, and then June came with ISIS and prices rocketed to $110 per barrel. What we're seeing now is that the fundamentals are coming through. So geopolitics have been pushed aside slightly because Libya has come back to the market, Iraq has been producing at constant levels for some time now, and the market's comfortable with this. So you had a deflation of price. Speculative people now saying, okay, well, I don't want to be long anymore, let me sell, 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 sell. And this is correct because the fundamentals were that the shale revolution in the US has brought in a lot of crude. I mean, they no longer import nearly as much as what they used to import. I think they're down to about 7 million barrels a day from about 10 million about 4 or 5 years ago, which is significant. And this is all because of the shale revolution. So the market is now pricing that in. It came at a little bit of a late response, and prices plummeted from 110 to where they're currently now at 76.60, which is very, very significant. Why is it significant? It's because energy is a rare commodity, and it's something that we need to look after in the future. It costs a lot of money for exploration. It costs money to go look in the deep Arctic. It costs money for all the shale technology. And the US has mastered this, and that's why it's a lower cost for them. But the rest of the world hasn't got there yet. I mean, for China to discover the same shale production capacity that the US has, it's about $110 per barrel break even, where the US is currently, now it's estimated at $65 to $70 per barrel, which is a bit of a strange thing because a couple of months ago they were saying it was 90, but now they're coming out and saying, well, we're actually comfortable producing at 65 to 60.
Chris, let's just get the historical context for this too, because things have changed.
Yes.
OPEC used to be the market maker.
No, that's correct, Dave. I mean, it used to be what they called the Seven Sisters. The Seven Sisters were the big oil producers. Your Shells, your Totals, your BPs. They used to produce majority of the oil. I think up until 1973, they were producing 85% of the world's crude, and that's when the oil embargo hit. That's where OPEC came along. They were formed in 1960, but they came along in 1973 together with the issues that the Middle East countries had with Israel, and said, we want to make our oil companies state-owned because the cash must sit with us. Why must the big oil companies take this money? And that's when prices rocketed. They went very, very high relative to the time, and demand was sapped. Demand fell away, sort of what's happening now. Demand fell away and you had excess supply. So prices plummeted and there was just too much crude on the market. On top of this, you had Norway, you had the UK discovering oils in the North Seas of Europe. You had the US producing oil at reasonably high amounts, similar to what we're seeing now. And Saudi Arabia was looked at, OPEC was looked at, can you guys please manage this? Can you cut back on production and manage this? They agreed to this. They said, let's do this. 9.9 million barrels per day is what Saudi Arabia was producing back then, down to 3.5 million barrels per day. What happens? Market economics come into play. When this happens, everyone else that is producing oil will fill that gap. So it doesn't matter that Saudi Arabia cut. Now, obviously, if you've been burnt in the past, you will learn from this. And this is precisely what's happening now. They've been saying it in their statements. They're saying, let market dynamics drive what's going to happen. To put a barrier, an artificial barrier in what's happening with the crude market is not correct. Let demand come back with time and let the world finally absorb all the oil that we are producing. There's no point in us cutting because either the US will step in, either China will step in if they develop the shale technology. Someone else will take the gap.
So the market is now operating?
Yes, that's exactly what's happening. So the free hand of what we call in economics, the free hand of the market must function and do its job. And that's where we think it's going to go today at 5 o'clock when OPEC announces
we have
what
to
they're
think
going to
about the economic effect for us. I remember, this is a long time ago, that you could fill your car for R3 before the oil crisis of 1973, and we weren't allowed to fill up on the weekends. That's how there was such a shortage that you had to fill up your car by 6 o'clock on a Friday evening, and the next time you could fill it up was Monday morning. It was tough times when that oil crisis happened. What's the effect going to be for South Africa? Good for inflation, good for all sorts of things?
Well, it is good for inflation. I mean, inflationary pressures are a little bit subdued, and globally this is the case. I mean, obviously with lower oil prices, this helps. But what you have is you have a lagged effect. What happens? People see that energy costs are lower, you up production because your costs are lower. So you can put that money into other areas of your business and grow. So the inflation effect, I believe, to be a little bit lagged. So you'll have deflationary pressures now, but growth later on. I mean, the US economy is stuck in between consumer and producer. They produce oil and they are big consumers of it, more so than they are producers. But the point of the matter is this drop in oil price will actually help the economy more than it will hamper it. And this will be the case globally for oil consumers. Yes, the oil producers, Nigeria, Angola, Venezuela, the countries that actually need a high oil price will feel the pain. But over in the larger picture, I mean, the industrialized nations will enjoy this. It will actually help with the economic situation.
Well, thanks for that. That was Chris Kairinos. Again, he is a commodities trader at RMB.